Welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham, and this is episode 72. Well, the Fed comes around and they just throw cold water on the market. And so we're going to discuss when will this choppiness, maybe when will it subside? We're going to look at some of the company earnings. We had a lot of company earnings this past week. How are they doing? How are some companies not doing? Some pretty poor performers out there. And so we'll just have a quick little episode here just talking about the market in general. But get your mind right and let's get to work. Well, welcome back. Another week. As I said in the intro, another week where the Fed throws cold water on the stock market. They raised the interest rate 75 basis points again. And, the commentary was more important than kind of the statement. So when Jay Powell put out the statement, the market went up 100 points, basically saying that they might start lowering the amount that they're going to raise by, right? So maybe not 75 basis points, but maybe 50 basis points, maybe even 0.25%. And so, but when he started talking, so after Jay Powell puts out the statement saying that they're going to raise interest rates, he then does a press conference. And in this press conference, I think every second he spoke, the market lost about $1 billion in value. So it's pretty tremendous, how much sway he has. And so the market keeps thinking that they're going to pause rate hikes, right? Like it's almost like, you think about racers in a race and there's like a starting gate and there's all this money on the sidelines and they're waiting for the Fed to say they're going to pause rate hikes so they can flood back into the market to try to, quote unquote, buy the bottom of the market. And so it's a very hard thing to do. It's very hard to buy at the bottom. You look back at stock charts and go, yes, I would have known I should have bought there, but it's just not that easy when you're talking about doing it in real time. And so what Jay Powell said is he said it's very early to even consider pausing rate hikes. And when he said that, the market went from plus 100. And when I say the market, I'm talking about the Dow Jones. When he said that, the market went from plus 100 to minus 500 points. Right. And so we got some of that back on Friday, but it was a losing week for the markets in general. And what he should have said is we don't see ourselves pausing, but we also don't see ourselves doing this large of rate hikes in the future. But of course, he didn't say that. Maybe he wants to see what the data is going to come out, the jobs numbers, these kind of things. And they're having a really hard time getting jobs numbers, employment to tick up. Sadly, the Federal Reserve is looking for people to lose their jobs. I mean, they are looking for the unemployment rate to go up. And I think that I have a couple ideas on this, but it's very, very sticky. And so you look at this, it's amazing how fast we have raised rates, how fast some of these stocks have been repriced. I mean, we have companies that are down 97% from where they were last year. I mean, the S&P 500, the biggest loser is Meta, which we talked about last week. That's Facebook. They're down 73% for other, some reasons of their own, but also because of interest rates. And so, there has been a huge discount in the valuation of these companies. I mean, you can get Amazon for 50% off from where you could get it a year ago. Google, 50% off from where you could get it a year ago. And so, these are real companies. But let me just share with you like the real consequences this has for like the average American person, right? So I looked up what the average American mortgage is, like the average home price. What's the average home price in America? And currently it's $428,000. $428,700 to be exact. So if you were to put down 20% on that house, which is, again, that's $85,000. Most people are not going to be able to do that. but for this purposes, I'm going to say they do. And so right now, you go to Wells Fargo. If you have A credit, which means a credit score basically above 750 would be considered A credit, depending on where you go. But that would be, you know, when you go to these websites and you're looking at mortgages and they're telling you the rates, I mean, that's like the top rate that they give, right? So you got to be able to check every box. So just kind of, if you're looking to buy a home or looking to buy something big, you just have to realize that most people don't get that rate. But here in this example, I'm going to give that rate, which is 6.75%. So if you buy a $428,000 house, you put $85,000 down, and you finance it for 30 years at 6.75%, that's going to be a monthly payment of $2,500 basically. Okay? If you would have bought that same house back in February when you could have gotten a rate of 3%, your payment on that house, same neighborhood, everything, would have been $1,729. So that is a difference of $790 a month. I mean, it's pretty substantial. So if you're paying interest at 3% on the 3% mortgage, for the life of that mortgage, you would have paid $177,000 in interest. And today, using today's rates, 6.75, you'll pay $457,000 in interest over the life of the loan if you keep it all 30 years. So the difference between buying that house in February versus buying it today is a difference of $284,000. I mean, that is real money. And that's real. I mean, that's $790 difference between, you know, the buying it in February versus buying it today. The $2,500 payment versus $1,729, that difference of $790, I mean, for most people, that's a car payment. I mean, that's their 401k contribution. That's their discretionary income to, you know, be able to go on vacation, to be able to do a lot of things. And so, you know, this is going to slow the economy down. Like, it is going to impact real, you know, Americans, and it is going to impact their ability to spend going forward. So there is going to be a little bit of a delay in these numbers. And so you'll hear commentators, you know, me, other people, and they say, you know, eventually the Fed's going to break something. And what they mean by that is that, you know, yes, you're seeing a lag here and it doesn't look like, you know, they're catching up to inflation, but all of a sudden it's going to be like, you know, there's an old saying that says the Fed has a better break, you know, meaning like, don't throw us through the windshield. Right? Because all of a sudden they just bring the economy to a screeching halt. And so you look to see, you know, are they going to be able to engineer a soft landing? I don't even know why people talk about that. I'm like, soft landing. I mean, like the NASDAQ's down over 30% this year. I mean, every category of asset classes is down, right? I mean, everything that was supposed to be safe has not been safe. Bonds are having their worst year in over 100 years. Stocks are getting crushed. Gold's down a tremendous amount, which is supposed to be a safe haven. Like, there's been like nowhere to hide. And now real estate, with rates this high, you're going to see some of these houses, home prices come down. I mean, like next summer when people try to sell their houses, they're not going to be able to sell them for what they think they're going to be able to sell them at, because people, quite frankly, are not going to be able to spend that much money on their, on those home prices. So those prices will have to come down, and that's how the Fed will be able to get control of inflation. And so that's what we're really kind of looking for here, is when do we think that the Fed will, you know, stop these massive rate hikes? And when you look like today, like they've already raised them 3.75% this year, which is it's a tremendous move. But again, they're going to meet again in December, 15th and 16th of December. So I'm sure we'll cover it then. But maybe at that meeting, we'll get our first like 50 basis point hike. Maybe we'll go back there. And they said they're going to have to leave rates higher for longer. And maybe in the spring, they will start to they're not going to lower rates, but maybe they'll pause. Maybe they'll pause and just leave them high and see how things go. But it's pretty interesting. I mean, we've had high inflation for a year now. And yes, it hasn't gotten worse, but even with all these rate hikes, it hasn't gotten better. And so, the American consumer, people still have a lot of money. We're starting to see, people put more on their credit cards and things like that. But the government, I mean, they flooded the U.S. with all this free money for people during the pandemic. And people still have savings, and that's starting to come down, but it takes a little while to suck all that excess back out of the economy to get kind of a more normal place. And so, you see, you look at the earnings of Amazon and Google and some of the big, what they call the mega cap tech stocks, and they have too many people. Like they need to cut expenses. They've said they're going to freeze hiring, but freezing hiring isn't enough. I mean, they really need to lay off people and really kind of get to a kind of a more normal level of employment. And so we'll see if they do that. When you look at some of the earnings reports this week, I talked about Carvana a week ago, I think, when I was talking about the wells and how I thought it was interesting that Bill Gates Foundation had bought this. And I never bought it. I never bought it for any clients. And I didn't, really recommend it. I just kind of pointed it out as interesting. Remember, not your financial advisor, talk to yours, entertainment purposes only, that whole deal. But this past week, I mean, Carvana missed on every single metric. And so on Thursday, they were at $14.40. And then Friday, they closed at $8.76. So a drop of 40% from Thursday to Friday. And, when you look back a year ago, I mean, my goodness, Carvana peaked out at $337. So you're talking about a drop of 97%. And so, if you're a company in today's world and you don't make a profit, it is going to be very hard for you to stay around. And especially if you have a company, if you're invested in companies that have a lot of debt, that is not going to be a good place to be, especially if they're not profitable, because they're not really going to be able to go out and get any debt at a price that's going to be helpful for them. I mean, it's really going to choke them out. And so you're probably in the next year, 2023, we're going to talk about companies going bankrupt or going under or getting sold for nothing. I mean, that'll probably be the conversation that starts to happen, which is pretty normal when you see this kind of move in interest rates and things of that nature. It just becomes hard for companies to survive if they're not making any money. So, previous episodes, we've talked about it a lot. I mean, you have to have companies that are profitable, that have their debt under control. I mean, it makes a big difference. So when you go and you look at balance sheets, I mean, you got to pay attention to what liabilities they have. I mean, this is a mistake I made early in my career. I mean, my worst investment ever was Lynn Energy, and I didn't notice how much debt they were taking on. Like, it was a complete disaster for me because I guess I was inexperienced at the time and just wasn't paying attention to it, and it really was just a poor thing. Now, that was an oil company, and oil dropped, and they had a lot of debt, so they had no way of being able to pay it back. Like, it was just a massive disaster, and they paid a huge dividend, which is one of the reasons I was in the stock. But if you don't have any money coming in and you're paying a huge dividend and you have debt to service, like, that is a problem. Like, that is not going to work out for you. And so, you have to be mindful of these things. I mean, they have real consequences. So, pay attention to the companies that you're in. When you look at some of the companies that are really working, it's the ones that, again, we've talked about, things that people have to have, or staples, if you will. Coca-Cola, Procter & Gamble, Johnson & Johnson, medical companies, Eli Lilly, United Health, like those kind of companies are gonna, are doing much better than, the tech high flyers of a year ago. Twilio had a horrible quarter. The tech, the Silicon Valley companies are having like a day of reckoning for sure. With just amazed at how bad things can get, how quickly. So now I'm a pretty optimistic person. So I look at this again as your ability until the Fed is done raising rates. This is a great opportunity for you to accumulate shares in really good, strong companies, right? Because even good companies have been beat up. So you have your list of companies that you want to own. You're not going to be able to time the exact bottom, and you have to be brave, dip your toe in the water, right? Be greedy when others are fearful. You have to be willing to say, okay, I'm good buying this company at this price, and if it goes a little bit lower, I'm willing to buy some more, right? So you eventually have to get to that point. Now, one thing I have noticed the past couple of weeks is that even though the market has been choppy, we haven't been having these 1,000-point swings. I mean, that 500-point swing we had the other day was pretty big over the last 2 to 3 weeks. So what that tells me is that, there's a lot of people that have left the market that haven't come back in yet. And so, or the people that are still invested are just going to stay, right? They're like, okay, I've held this stock. I've been holding these companies. Like, I'm in it for the long haul. And so kind of the leverage is gone. People borrowing money to invest is gone. And so you're not getting as wild of swings, which is kind of nice. I mean, maybe we'll get to this flatline point. But one of the ways you can tell if a stock bottoms or not is a couple different things, couple different ways. But one way is to notice if there's bad news that comes out on a company and it doesn't go down anymore. That is pretty much the people in the stock saying, yeah, I knew it was going to be bad. I totally get it. I'm not selling. I'm sticking with it. I think it's going to be better in the future. I'm not selling out. Right? So if you have bad news that comes out on a company and it doesn't go down, that's a good sign that maybe a bottom is near or close. So, and we'll see this week when we have the midterm elections. Maybe those won't go to a recount. Highly doubtful. But we have elections this week. And again, just remind you that there has never been a time in the last over 100 years where after the midterms, from the midterms to like June or July of the next summer, the stock market has been up every single time after the midterms. That's the historical data. It doesn't mean it's going to happen again. Obviously, COVID has just kind of thrown a wrench in every single thing, and just the aftermath of it that we're kind of dealing with here. Because that is really what this is. I mean, all the things that we had to do to kind of help people through COVID, we're paying for that now and some of the decisions before. But anyways, back to the election, like 22 or 20 or 22 times out of 22 times, the market has been up from the midterms to July of the following year. And so if the Fed were to pause rates maybe in March, you would probably see a pretty strong rally after that. So that's really what you're kind of getting ready for. So when times don't look good, I mean, you really have to think, okay, I'm putting this money to work. I'm willing to stick by these companies, and I'm willing to put more in if things don't go my way. And some companies have had great earnings, McDonald's, Starbucks, there's some reports that China may open up. I mean, I'll kind of wait on that. I mean, there's been so many, Chicken Little, comments on that, or did the China's going to open up and then they don't. I mean, there's so many, that's just too hard to try to predict. But those kind of things, buying good, strong companies, even in times of, economic trouble, they do well and they do better when things turn around. They actually move up faster than everybody else. So if you're looking at, different sectors, go find the market leaders, and those are the companies you want to be in. So I hope this is helpful for you. I hope you have a great week. Don't mistake activity for achievement, and I'll see you next time.